So, hi everyone. I hope all of you are excited to learn, what are your tax implications in the US. We are talking about mutual funds. So, in the US, mutual funds could be taxed in three different ways, and those ways are available to the all the investments under PFIX. Basically, those should be passive investments into foreign corporations. Now, mutual funds, as Rumit rightly said, are PFIX. So the three elections available, the first one is a Section 1291 election. It is also referred to as deferred taxation. Basically, you are paying deferred taxes under this. This is the default rule. So even if you don't make any elections, even if you don't file your Form 8621s, if you don't file your 8938, or even if you don't file your tax return at all, this is the default election. So if you don't do anything, this is the section under which you will pay your taxes. The second election is a 1296 election. It is also known as mark-to-market election. This requires Form 8621 to be filed and a specific checkbox to be elected to make this election. The third election and the less common one is the qualified electing fund election. That is under Section 1297. Why this is less common? Because the mutual funds do not provide the information that is required to make this election. So we will not be covering more details on this. It is just because Indian mutual funds, those that are listed, do not generally provide information required to make this election. Now, these elections are for each PFIC, right? Each PFIC or each mutual fund. But when you calculate the taxes for the US purposes, that would be done at a stock level. So let's say if you bought 5 times the same mutual fund over a period of 1 year. So for the US tax purposes, you will have 5 tax calculations. Though the reporting is together and the election is together, but you will have 5 separate calculations to report for US tax purposes. Now these elections, the ones mark-to-market election, a 1296, or a qualified electing fund election, those elections are easy to do but difficult to revoke. Revoking is very complex unless it is automatic. Like for 1296, if the fund is not listed, then you automatically don't have the option to elect and it gets revoked automatically. But if not, then the process to get the election revoked is complex. For the next slide, before we go into the calculations, let's take a look at certain basic items that you need to understand. Right? For ordinary income and losses, just keep in mind that ordinary income and losses are always taxed at the taxpayer's tax bracket. So in the US, you have tax brackets for individuals. If there is an ordinary income or loss, it will always be at the tax bracket. Second is capital gains. Capital gains in the US have a lower tax rate than the tax bracket. So there is a 0%, 15%, 20% rate, which is available if based on your taxable income. Capital gains or losses are treated as long-term gains or losses if they are held for more than 1 year. FMV is a fair market value. That is basically the listed price of your mutual fund in India. And excess distributions. Excess distributions means dividends minus 125% of last 3 years average dividends. So excess distributions are relevant when we will discuss 1291 taxation or deferred taxation. Okay, for Hemant, can you please change the slide?
Yeah. Thanks, Jaydeep. Would also be helpful if you can give a snapshot of what are the key differences between the first two methods of tax calculations as well.
Yeah. So the first election, that is the default rule, is the 1291 deferred taxation. As you can see in the chart here, let's keep $1,000 as a base price or purchase price. If you have a gain, that is basically above 1,000. Whenever you have anything, a price above 1,000, it is only taxed when you sell it. In the deferred taxation rule, gains are only taxed when you sell it, or losses are only taxed when you sell it. There is no taxation in between in your holding period. And the gain that are taxed are basically taxed in such a way that you are also going to pay interest from the date of your holding, original holding. For the 1296 election, 1296 is a mark-to-market election. So you pay taxes every year based on the price as on 1231 of those of all the years. Now, if you have a gain in this situation, in the example, $1,000 is your purchase price. If the fair market value is $1,200, you obviously have a gain of $200, and that is reported in your tax return. Now, if the price is between 1,000 and anywhere above, those gains or losses, the fair market value could be anywhere above 1,000, gains or losses are allowed, and those are ordinary gains or losses. But the loss below $1,000, that is the base price, is only allowed when you sell it. So in any situation, if you elect for a 1296 election, the loss below the purchase price will only be allowed when you sell it. Otherwise, the loss will not be allowed. Now, this chart explains the pricing and how it works, but let's go into a bit of details in the next slide so that you better understand what are the differences. Both the elections have certain terms here that we need to focus on. How to elect for 1291, there is no requirement to elect anything. As I said, it is the default election. Even if you don't file your tax return, this is the way you will be taxed. For 1296, we have to file a form 8621, and we can switch in any year by paying the deferred tax. So in the first year, you don't need, it's not necessary that you elect it itself in the first year. You can elect later on, but then you have to pay taxes under section 1291 till the date of election. What happens on the gains? Gains are calculated as sale less cost or basis for 1291, and the gain is taxed as deferred gains. But for the mark-to-market election, gains are taxed as sale less lower of last year's fair market value or basis. Gain is always ordinary income for 1296 election. So for 1291, the income is not directly reported in your tax return. It is just directly tax plus interest that is reported. But for 1296, every year you report ordinary income or loss in your tax return. Now, what happens to losses? Losses on sale. For 1291, those losses are allowed under the normal provisions. You will have never recognized the income, but the losses will be allowed under normal provisions as capital losses. It could be long-term or short-term. If more than 1 year, it would be long-term. For 1296 election, that is the mark-to-market election, losses will always be ordinary losses, but only allowed if you have previously been taxed for ordinary income. If you do not have any ordinary income recognized in previous years, then no losses will be allowed. Now, in the year of sale, if the losses extend beyond your ordinary income that is already taxed, basically in the previous slide, we saw that if we sell it for $950 and your cost is $1,000, the $50 that is below the cost price is taxed as capital loss. Everything else will always be ordinary. What happens during the holding period? So in 1291, there is no gain or loss in the holding period. But for 1296 election, gains or losses are possible in the holding period when the price fluctuates based on the market value as on December 31st of every year. Now let's take a look at dividends. Hemant, can you please change the slide? Yeah, so tax on dividends. For 1291, there is a term that is excess distributions. I already explained the definition of it. Let's say that if you have excess distribution, it is the same as you have a gain. You will be paying taxes at the highest tax rate plus interest, and the dividends are not qualified dividends. For the US, again, qualified dividends could have lower tax rates, but in the situation of 1291 or for 1296, dividends are always taxable, but as ordinary income and not as qualified dividends, so we do not have a benefit of lower tax rate or dividends on mutual funds. What about tax credits? Tax credits are never available for sale of mutual funds. So if you sell it, and if you paid tax in India, they are not available. But in the situation where you have a dividend income, tax credits are available against tax that is payable in the US. So you paid taxes in India on dividend, and you can take the credit of those taxes in the US. What are the tax rates that are applicable? So for 1291, the tax rate is the highest tax bracket. So highest tax bracket for 2022 is 37%. So that will be the tax rate, but you have to allocate the gain to all the years that you held. And there is additional interest payable. For 1296, tax rates are the ordinary tax bracket that you are under. Right. So a note here that when I mentioned that 1291 gains are taxed at the highest tax bracket and interest, please note that the interest is payable for your entire holding period. So the taxation happens in such a way that the US government basically treats that you had earned this income for all these years and you did not pay taxes on them. You are paying taxes in the year of sale. So interest is payable for your entire holding period, and there is a specific allocation and calculation that goes into determining the amount of interest and the tax that is payable.
Yeah.
Now, the third and the final election is the qualified electing fund election. The QEF election, as I said, most of the Indian mutual funds that are listed do not provide an information statement that is required. So a PFIC annual information statement or intermediary statement is must if you want to elect this qualified electing fund. What happens in this situation is that if the mutual fund earned capital gains, your income is also capital gains, and you cannot retroactively elect this. You only have a prospective option, but must pay tax under the 1291 deferred tax rules. That was all about taxation of mutual funds. Over to Nishad and Hemant from INRI, who have a beautiful product for investing into India and may solve many of your issues and confusion.